Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Thursday, the 21st of March, Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. And we're going to go through our usual regular run through here today. It's going to be a big central bank day today to talk about. Not just the Fed, by the way. Loads of articles on the Fed, but we'll take a look at what's going on in the world of central banks. We'll take a look at what's going on in the data coming up. We'll take a look at the reactions. We'll take a look at what's going on in the charts. So, before we wind back to yesterday's Fed, two things to point out. If you're in Europe, you may have seen this already. If you're not in the US and you're just waking up, you may not have. So the Swiss National Bank. Now, when I ran through all the central banks, I often scoot over the Swiss National Bank. They're usually very in lockstep with the ECB, sometimes a little out of lockstep with the ECB, but usually in lockstep with the ECB. And there was no expectation for anything to happen from the SNB, the Swiss National Bank, today. We've also got the Bank of England today, which I'll talk about shortly. But so we had the RBA, the Reserve Bank of Australia, early this week. We also had the PBOC. We had the Bank of Japan, obviously hiked out of negative rates. And obviously the Fed was the big focus, and BOE, so Bank of England today. But this S&P was kind of off the radar, and the S&P cut rates this morning. So, so of all the what you would class as the world's major central banks, the SNB has gone first. They beat the ECB and they beat the Bank of England. They beat the Fed to be the first to cut rates. So we had an interest rate cut from the Swiss National Bank. So highlighting that we are in rate cut territory. Rate cuts are on their way. And so let's get used to that. So that's one thing to say. Then looking ahead into there's some articles here. So actually, if you go to the US briefing, I think this is really I don't know. Obviously, we don't know exactly how much people are using the resources on Trade Day, but I think this is a massively underused resource. So if you go to the columns where you are, I'm not going to go to the where you're watching this, because if you're watching it live, that is, or on the recording, because if I go there, I'll hear myself playing, and you don't want to hear me, and we'll get a feedback loop. But what you will see is there's the three columns, and the right-hand column is the live squawk news briefings, the European, US, and Asian news briefings. And this is the US briefing. So this is where I try to come into here most days, and they just give you like the breakdown of the headlines, so you can you can just come in here and see what straight happened, going into the US Open, and they've actually got their own articles in here, so you can see the articles actually from Live School themselves. So one about the Bank of England, which I've opened up, we'll come to, and also about the Swiss National Bank. So analysts say more reductions to come. So it was obviously a dovish cut as well, lowering by 25. Movers by about a third of traders on money markets. So there was, but with most analysts predicting a hold. So the markets had priced in a potential, but only a 30% chance of a rate cut. Analysts weren't looking for that. And you can see that, and there's the articles here. So I'll just pop these into the chat. I mean, you can get them. You can access these yourselves in that panel below. And then looking ahead to the Bank of England, we're not looking for anything today to stay on hold from the Bank of England, but maybe some kind of dovish tone. So that'll be interesting as well. Okay, to see if we get some kind of dovish tone. And that comes up shortly, right? We've got that. If I jump back to the calendar, we've got that coming up in less than 30 minutes now, 26 minutes, the Bank of England. So if we get some kind of dovish shift there, all this is going to do is fuel what we got yesterday. And I'll come back to the Fed, because obviously it's probably the most important thing. But I wanted to get through the calendar, and just so you don't miss this, so I forgot as well. But I mean, this was a real surprise this morning from the SNB. And obviously, we're going to say got Bank of England. We've also had out in here, and it's been fairly mixed, but slightly more on the negative side in here. We've had the flash PMI data. And remember, for the US, the most important PMI data is the ISM, the Institute of Supply Management. But the Institute of Supply Management do not provide us with the flash PMI, flash being a kind of an early preliminary look. So this data is that all this data in here, you can see all this. So this is the same HCOB and S&P Global is the same, right? And SIPs, okay? So these are all the same. But basically the parent is S&P Global. So all of this this data is from these sources are for the global economy. We look at this data from S&P Global / HCOB / CIPS for the UK. So that's the data we look at. Okay, but for the US, we look at the ISM data is more important. S&P Global do provide the US data as well, and if you remember, it usually comes out on the first few days of the month. The first print is usually the first day of the month if it's not a weekend, and then we get the both of them usually on the same day, and the ISM and then the S&P Global data for the US. But we don't get it. Remember, we don't get it. The ISM number for this preliminary flash data, which is, I say, this is the data for March, and we're still in March, right? We're only 3 weeks into March, but they go with this with I think it's about 80% of respondents. So it's usually very much when we get the final data. In a week's time, it's usually very much in line with what this preliminary data is, and usually the S&P Global data and the ISM data isn't too far away. So this is important data because this is going to give us a real clue, a heads up as to what in 1 week's time the actual official S&P Global data is, and also what the ISM data is going to be. So we're going to be watching that. So we've already had for the Eurozone today. You can see up here for France, it kind of just missed. For Germany, it was mixed, beat and miss, okay, on manufacturing and service, missed on manufacturing, beat on services. For the Eurozone as a whole, mixed again. We've got the manufacturing, services and composite, so beating on the service. So the services data seems to be doing slightly better in here. And if we go and look for the UK, again, mixed in here. So missing on services in this case, beating on manufacturing and misses on the conservatives. So, on the composite. So it's a real mixed set of data. But the positive surprise we've had obviously today has been the SMB. So we've got the Bank of England coming up, and then later on, obviously, we've got that S&P Global data. So it's 9:45 Eastern. 9:45 Eastern today. We get this flash preliminary. You see the little P is the preliminary there. It's the flash, also called the flash PMI data. So flash PMI, preliminary PMI data for the US for manufacturing, composite and service sectors in here. So manufacturing, services, and then it's the composite is the adding up of those. That's at 9:45 Eastern time today. Remember now the Fed's coming out of blackout, having had their so we had the blackout period, having come out of having had the meeting now and the decision. They're out of blackout, so we've got Barr speaking today. Okay, so watching out for Fed speakers there, how they now are going to be talking about obviously what they discussed at the meetings and what their views are going forward. And we'll come to the Fed in a second. Okay, I know I'm not got to the Fed yet, and it's the most important thing in some ways, but I think all of this that we've had today really reinforces was particularly the SMB, and then potentially if we get some kind of dovish shift from the MPC, that's the MPC is the equivalent of the FOMC, the Monetary Policy Committee, MPC of the Bank of England. So if we get some kind of dovish tone, they're not going to move rates, but it's what's in the detail, the devil in the detail, right? So Swiss National Bank is cut in here, so start using this resource. It's a really good resource, guys. Bank of England expecting to remain on hold, but will we get some kind of dovish pivot? So here's some of the Switzerland surprises with rate cut moving ahead of makes its moves. First move is first among the world's 10 most traded currencies. Only a small minority of economies anticipated that, so it was definitely caught them off guard. So let's just go through 5 things to start your day. There's a lot in here about the Fed. So Fed stays on hold, but it was definitely a more dovish tone, certainly. Look, Fed bonds will come into view fairly soon. Powell's slowing the pace of reduction in the Fed bond holdings will come into view fairly soon. So this is the potentially quantitative tightening, but it was definitely, calling it a Goldilocks narrative is still very much in play. Not too hot, not too right, just about warm enough. Okay, so that's what the Goldilocks is. Not too hot, not too cool, just about right. So that's the Goldilocks scenario. Okay, so this is sent on. It says buy signals to flash across Wall Street. S&P 500 closed at a record in here, and then obviously, well, not obviously, but the more dovish tone than we kind of expected means a weakening of the dollar because he's less attracted to own dollars if interest rates are going to be lower than what we expected it before the Fed. Okay, so that more dovish tone means we expect by potentially compared to 24 hours ago. It means that less attractive to hold dollars. So the US dollar sells off, and then the gold rallies because gold quoted in dollars. So then that's seen gold surge higher to a new record level. AI still doing well. We've also had chip maker Micron Technology, strong revenue forecast. And that's gone higher and keeping AI in focus. The Reddit IPO, Reddit starts trading today, I believe. Yeah. So Reddit starts trading today. So we'll see how that goes as well to see if there's strength on the IPO side. And then mentioning here, we've obviously got the data in here, the PMI data that we spoke about already. Okay, let's run through a load of the articles in here. So Fed signals 3 rate cuts. Remember what I said yesterday? The market had got itself. So if we wind all the way back to the last dot plot chart in December, when the Fed said they were going to start cutting rates, indicated that rate hikes were over and they were going to start cutting. The market then jumped to anticipate that by the end of this year we'd had 6 rate cuts. So by the end of last year, the market's anticipating 6 rate cuts, even though, as we looked at yesterday, the Fed dot plot chart said only 1 rate cut. Sorry, not 1 rate cut, forget that. Only 3 rate cuts. So the Fed dot plot in December said 3 rate cuts. The market got ahead at 6 rate cuts. Then the Fed, for the first 3 months of this year, have been winding the market back in. No, we're not ready to go yet. We're not going to go in March. We're not going to go in May. So the market had anticipated initially cuts in March, cuts in May. Now we're anticipating cuts more likely in June and July. And that's where we were yesterday. And then the fear in the markets, and then what we were talking about yesterday, and what's a lot of speakers and economists and strategists were talking about, is maybe the Fed will move to only being, maybe the medium forecast, which we looked at yesterday, will move to only being 2 rate cuts this year. And the market would have been very disappointed with that. That's why in the last week, after the inflation data last week, we've seen bonds sell off and yields go a lot higher, because anticipation that maybe because of where the inflation numbers were, the Fed weren't going to cut. And if the Fed are not going to cut, then bonds sold off and we would go to higher yields because we're not going to get as many rate cuts. And then basically the Fed, if anything, allayed the fears, okay? Lifted their forecast for growth, so that's positive. So generally it was seen as what we kind of call a Goldilocks, not too hot, not too cold, just about right, and delivered what the market wanted. And hence, then we saw stocks obviously surging higher. Gold is not up because we're in a risk off. Sometimes gold is a safe haven and goes up. We're in a risk off scenario. Gold is going up because the dollar is weakening. Okay, a weaker dollar, there's an inverse relationship. Gold is quoted in dollars, so inverse relationship between the value of the dollar and gold. And so the dollar has weakened, so gold has strengthened. And there it is. Gold jumps above 22 ounces for the first time on a dovish Fed. What else? Fed states. So there's a load of stuff in here. I'm just going to run through all these headlines. Fed stays on track for rate cuts with one eye on bumpy inflation. And then we've got Powell said it'll soon be appropriate to slow the pace of QT. So at the moment they are tapering. They're going through quantitative tightening. So they're going to slow that. So that's actually also, they're going to slow quantitative tightening. It's been winding down its balance sheet. So reselling bonds that it bought, taking liquidity out of the system. It's going to slow that down. So that in itself, means this tapering means it's going to reduce the chance of stress in the funding markets, and also means it's a kind of a slightly dovish shift as well. Traders embrace Fed's Goldilocks outs to lift world markets, and then SMB as well being mentioned in here. Fed forecast shows policymakers will still see 3 cuts, and that was the fear, remember, that we weren't going to get the 3 cuts. I don't know why I clicked on that one and opened that one. And there's a load of stuff from Reuters in here the same. Looming US stock change. Oh, no, not that one there. Sorry, forget that. So we go. Reuters, Fed balances balance sheet drawdown taper is coming soon. So they're tapering the drawdown. Steady Fed outlook boosts stock markets. Hopes for coveted soft landing. The soft landing very much in play. Fed outlook's looking good. Futures gain as Fed sticks to rate cut projections. All the same stuff we've been going for. Fed sees 3 rate cuts in 2024, but a more shallow easing path. And then Finally, European stocks are up as well on the back of this, with the Swiss National Bank, and even though the eurozone PMI data was mixing here, look, eurozone business activity close to stabilising in March, so slight positives on that broader eurozone data in here. And there's the article that we mentioned there on Micron. So Micron in here, under Micron Technology, underlying the positivity in the stocks. So if we go and take a look in here now, look, so this wasn't the case. So now in the May, there's even a little slight chance of a rate cut in May. That's not going to happen though. But if we go out to June and July now, so if you look in here for June, what we see in here now, the market is very much anticipating that first rate cut to come in June. And look, an outside chance of a half point, right? And then we go to July. And then by July, only a 14% chance that we don't cut rates. So this is a lot far improved from where we were yesterday. And now if we go to the end of the year, so the market's starting to get ahead of itself now. So look, 450 to 475. This is the 3 rate cut, okay? But then, this in here is still strong. So now only what's this? A 20% chance that we won't be down by 3 rate cuts, okay? And there is in here, what's this, 31, 41, 43, 40, 44, 45% we have maybe 4 or more rate cuts, okay? So the market's starting to price in a little bit more of a risk. Even though the Fed's sort of sticking with 3, the market's still got a toe in, well, maybe they'll give us 4, okay? So the market's a little bit more excited than the Fed, potentially still in here at the moment. And so what does that mean for, oops, no, I didn't want this one. I was going to go to, so bonds in here have retraced back lower. We're already heading lower, back from early this week. Yesterday it was very choppy in the bond markets. The bond markets across the board are up and down. But if you look now, today we've gone lower in yields. Okay, so lower in yields, and that's going to be positive for stocks as well. And if you go and take a look in here, so you see it was choppy in here. 30-year, you can see in here. This was done last night, obviously, but you can see in the chart, 30 years were choppy. 10 years choppy as well. It's up and down, but now we're starting to push. The short end had a clearer path higher, because obviously it was driven by, the shorter end is more driven by the Fed and driven by the central bank, where the longer end more driven by the economy. So we saw a more significant push higher in price, which is lower yields at the shorter end of the yield curve. But stocks obviously surging higher. The S&P hit a new high, and we did have more of a negative view previously in here on the NASDAQ, because this looked like a topping pattern going in, and the NASDAQ surging higher with those lower yields. And then looking positive again, if we do the recap on the overnights in here, so the Nikkei and the Hang Seng both up with US stock averages this morning, so 2%, but just either side of 2% for the Nikkei and the Hang Seng. European exchanges not doing quite as well. The FTSE is doing well, but the European exchanges are up. The CAC's actually down in here this morning. And if we go to the US averages, obviously we're up about 1% yesterday. The Nasdaq's up nearly 0.8 this morning. The S&P about 1/3%, and the Dow just under 1/4%. So all looking still very positive in here. Let's go and quickly jump in here to the charts in here. I just want to quickly start with the non-equity markets in here. So here's gold. Look at that surge higher in gold from yesterday. Big push higher in gold. And if we could flip it to the daily chart, boom, boom, and then up again today, to a new all-time high on the back of the Fed, and also being helped probably by the Swiss National Bank as well in here. If we go and take a look, a quick nod to the bond market. So here's the 10-year, obviously pushing up in price. And if we go to the 2-year, boom, a much bigger move on the 2-year, and no surprises there, higher in price, lower in yield. And finally in here, I'm going to come back, go to the... So a significant sell-off, bearish outside pattern here for the dollar. This is the dollar index, but we haven't a bounce in the dollar today. So gold not only being driven by the dollar in here, but gold, but certainly the initial move yesterday for gold to the upside was driven by this dollar weakness. But the dollar is in here not aggressively negative, and we've actually had a bounce in the dollar in here today. Let's go take a look at the stock indices. So no surprises, Nasdaq up yesterday and actually pushing up to the all-time high on an intraday basis in here. So that's up on the June contract. We are up at 18,691 and a quarter, and wouldn't be surprised if we go and have a play with that early on today. Here's the 30-minute chart. It can't be anything other than bullish. A big move up yesterday, grinding up overnight, and then dipped and rebounded already. And if we go to the S&P, big move up to new high yesterday, another move higher in here this morning. And again, if we actually go back to that daily, look at the way that 13-period EMA worked really, really well. The market flirting with it over the last few weeks as we've waited for the Fed, held above it even during that inflation data last week that was hotter than or warmer than expected, and boom, now impulsively moving away. And then look, big push up, strong move even higher overnight, and despite the dip in here, then rebounding already in here and looking to the upside. So can only go into today being bullish, really. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Have a good one. Take care. Stay safe. For me, there's only one way to play this if you're in the stock in the season. That's from the long side today, just picking your moments. I'll be back with you for the final bull versus bear webinar of the week tomorrow on Friday. All right, one.